The S&P 500 ending the week flat despite blowout earnings from some of the biggest companies in the market. The Dow and Nasdaq actually down on the week. So if record profits from the most valuable companies couldn't get investors excited, what will? Or is the best already baked into these markets? Tim.
Look, it's disappointing, and certainly if you told me the numbers that Google and Facebook, especially on their ad growth and what that means also for the consumer and the economy, then get to Apple, 5G supercycle alive and well, their service business is growing, and Amazon might have had the best numbers of everybody, and you actually week over week had triple Qs or the NASDAQ 100 down 51 basis points. Very concerning. You look at semiconductors. They haven't made highs since mid-February, so 2.5 months. This is one of the longer periods of this rally where the leadership, which has come from the chip sector, has kind of deserted us. So in a market that's always looking for a catalyst, earnings typically at times have been really important. And I do feel that at some point when companies tell us they're back to normalized earnings, and the tech sector's kind of told you that, and we pulled through some of the COVID benefits and we have tough comps, that's a time to be concerned. I'm not losing faith in this market, but I do think this was a concerning week. Small caps were weaker, EM growth was weaker, and it was a tough call based upon great numbers.
Some might posit, Steve Grasso, that a flat performance by the major averages is actually decent price action considering where we started this week off at, which was record highs.
Yeah, I think that's probably the way I would start to frame it. But Tim did a great job in laying out all the different places within this market and what they've recently done. I've been a fan of saying that the market really sets up to hurt the most at any one given time. And what would hurt the most is that everyone thinks we're going to roll over. If we don't roll over and we trade to 4,500, I think that people are shocked and people wind up getting hurt to the upside. But for the most part, people are sort of looking at the market and saying, let me just stay invested. Let me own tech. Let me own some of the IWM. Let me own some of the infrastructure plays and the industrials. We'll see how it plays out, but I can understand taking some chips off the table.
Some might even say some of these pullbacks in some of the big cap tech stocks, Nadine, could be buying opportunities. I mean, the good thing is that you've seen what their hands are, right? You got the quarter readout. You got forecasts as well, so you know what you're dealing with pretty much.
You're right, Mel. And what you saw today, too, is the market was down, but volumes were down. So there wasn't a lot of strength behind this decline today. And you're also looking at implied volatility premiums on the Qs of 22%, on the SPY of 36%. So again, we're looking at, I think, a pretty attractive setup. So just you mentioned on the opening, Microsoft, that was something, we've been longtime holders of it. I entered again today and just added to the position because it's a great company. They put up a great quarter. People right now on earnings, though, are paying for the surprise. So are they going to surprise on the upside with a forecast? But I think Microsoft did a great job of outlining a very reasonable, pretty conservative look that they can beat.
Yeah. James, how did this week's price action feed into your bearish view of the markets?
We've had an incredible bull market. I saw a headline the other day that this first 100 days of the Biden administration since the inauguration is without peer. You have to go all the way back to FDR coming out of the bottom of the Great Recession. 88 years we haven't seen a rally like this. And so it's not surprising that the market would, as we're shrugging off some of these great earnings numbers because they've been priced in. There's been so much expectation of a rebound and a re-acceleration of the economy. Most of that was priced in after the election. It's continued to rally. We saw this last month, nearly 18 days of consecutive rises in the S&P. This is probably the first time we haven't bought the dip after the market closed today, selling off. And so it's just been an unprecedented rally, and obviously it has to come to an end at some time. We're still not betting on the market collapse because the market is continuing to rally, but we've got to top out here at some point.
Tim, how do you feel about the stocks that actually managed to do well off their better than expected earnings? And I'm thinking of Facebook as well as Alphabet, which actually finished the week with gains versus a Microsoft, which arguably had a very good quarter as well, but finished the week lower.
Well, I think both Google and Facebook are valuations that are the most attractive of those mega cap tech stocks. In a world where, other than Amazon, which has always been expensive and I think is actually cheapening as it's growing into better operating margins. But look, Google's numbers really tell you that this company is beginning to re-rate a bit more. Facebook's been very cheap, maybe cheap for a reason. The strength in the ad growth, and again, their pricing, right? We saw that they're able to pass on 30% price increases. Google's, intrinsic value in YouTube finally coming out, and all this, by the way, it was a really bad week for Netflix when you consider the Amazon Video Prime numbers and what Google told you and the strength of YouTube. But that's maybe for another show. But those are the two that I think are the most defendable. Those are the two that had the big weeks. Those are the two that, yes, they reversed a bit off those highs, but still the stock's legged higher. And I think those are the ones you stay with.
Mm-hmm. At the same time, Nadine, I'm curious if you think that maybe today's action was sort of a tell in that. I mean, were you surprised that tech stocks didn't do better, especially the ones that posted decent earnings like an Amazon, given the 10-year yield wasn't that strong, wasn't as strong certainly as we saw yesterday, went down to 1.62. I thought we might have a little bit of a bid there.
In terms of rates, as you know, the last few shows I've been on, we've been shorting things like the TLT, shorting the treasuries. But I put out a note yesterday. We saw the XLF, so that's financials, and XLE, which is energy, hitting the top ends of our daily trading ranges. And they call it a rhyming cousin of the treasuries. And so when you're seeing rates hit to a point where you need to trim some financials, trim some energies, then what we think about is covering those shorts on the treasuries. And again, there was a note put out today of just the high short interest on the treasuries. That's another thing that gives you pause and says, okay, this is somewhere maybe we don't want to overstay our welcome. Let's look for a better way, a different way to play this.
Shepard Smith here. Thanks for watching CNBC on YouTube.